All right, let's widen out. Take a look at the bigger picture with Ted Thatcher, President Bright Lake Wealth Management. Ted, thank you so much for joining us this Friday. Let's talk about kind of the macro picture. We had some economic data points out this week. Today, we just had our housing starts, building permits. In the context of that, we've got the next rate move on the horizon, November 7th, just after the election. What do you anticipate the Fed's move to be?
Well, it's great to be with you, Diane. And I think it is important to think about, of course, the Fed here whenever we think about the big picture. We've heard from Jerome Powell time and time again over the last several years that the focus that they have had has been entirely almost on inflation. And they've only started to make the change in, the interest rate decrease considerations once they started to see the unemployment number tick up. We have to then say, okay, well, if the jobless numbers that we saw come out last week were, beating expectations, better than expected, if the retail sales numbers beat expectations, that makes it harder and harder for Jerome Powell not to see some concern about potential continuations of these significant interest rate decreases. The market is starting to price in this assumption that we're not going to get quite as substantial of decreases. For the third week in a row, mortgage rates on the 30-year mortgage are up, actually, despite, the assumed trend that so many have considered of the interest rate environment coming down. And so I think really what we're going to see come the next Fed meeting is Jerome Powell is going to be very, very sensitive with the kind of verbiage he's using. I think he's going to use a lot of the sort of I'll say even word salad that he has before. I do think that we will get a decrease ultimately just because of how high rates have been. But what I think this is really telling us is that we it's quite likely anyway, that we're going to see a slower trend of the decreases over time instead of some of the bigger steps down that so many have been looking for.
So a slower trend in the decreases over time, then are you in the camp that believes we will see a cut of 25 basis points in November? Or are you expecting a pause?
I think that at this point, you have to underwrite some probability that we won't see a 25 basis point cut. But still, if you said, Ted, what if you had to make a decision on choosing whether we saw no cut or a 25 basis point cut? My gut really still says we will still see, again, a 25% basis point cut. But again, with a lot of that sort of, I'll say, word salad couching of the overall trend from Jerome Powell in November here.
Okay, and then you mentioned the unemployment rate, and then in recent commentary we've heard from Powell, it seems that their attention has turned to more of what the job market picture looks like versus inflation. And inflation has been cooling. We had some new jobless claims data out this week that were better than expected. How do you think the Fed will interpret that?
Well, I think when we look at the economy broadly, there's so many different ways we can measure it. Obviously, we could look at the stock market and, how high or how near we are to the all-time highs. But of course, really quickly, when we're also analyzing the market, we say, okay, well, how is the American consumer doing? That's going to really speak to how the economy is doing overall. Really, with the data we've been seeing, I think that the American consumer as an individual is doing surprisingly well, or I'll say they're surprisingly durable. We see, of course, the headlines about the concerns around consumer sentiment. We've seen how high the debt load average Americans have been carrying, and of course, how inflation's affected them over the last several years. We can also look at the results at the end of the day. And this year, Americans have traveled more this past summer than they ever have before. And so we're seeing still some spending power that is and has been durable from the American consumer. I even think about what Walmart's CFO said at their last earnings report, and he didn't, say that the American consumer is, in the best place they've ever been and stronger than they have ever been. And of course, I think that's the case. But what he did mention is that he didn't see any specific market weakness in the consumer. And so, yes, Americans are being more thoughtful with how they spend on, necessities, but we're not just seeing the bottom fall out. And so ultimately, because of that, and then of course the consideration with the jobless claims figures that you mentioned, I think that all that comes together to say, hey, well, it's going to be a harder argument for Jerome Powell to lower those rates.
And so that's one of the conversations that we've had with different analysts, is just that the American consumer has been holding up better than expected. Even if you go back to, when there were more concerns about the potential for a recession, for most industry analysts, it seems to be that that is a reduced expectation. But let's talk about kind of what's caused some volatility in the market, the upcoming presidential election. How do you expect that to impact market action?
Well, obviously you can look at so many different polls, and at the end of the day, I think this is going to come down to being a very close and very tight election. There's a lot of time still in terms of the campaign trail. We'll see how it ends up, turning out. But whenever there's a presidential election, it creates uncertainty in the markets. And so whenever we have uncertainty, obviously you see the VIX go up very often. And, where do we go then? Well, I think what the market likes, or what is generally safer, is to look at what's been really reliable. So when we think about a presidential election and the uncertainty that comes with it, well, let's take the other side of that coin. What has performed well? What has been reliable? And then I immediately, of course, go to the blue chip names, the blue chip stocks, the Mag 7, and really those large cap positions. Of course, they performed well in the past. They are more reliable and, consistent, but also we can see a potential tailwind. And of course, we've heard that phrase so many times, don't fight the Fed, right? And if we do believe that even if it's a slower rate decreasing environment, that those rates will come down over time, then that tells me it's very likely to be the case that certainly over the medium term and, certainly likely the long term, with a lowering interest rate environment, those large cap names, those blue chip stocks will probably see some tailwinds, and they can be a really nice place to look for returns in a time like.
Okay, financials also performed better than expected in this latest earnings cycle. How do you feel about financials?
I think what Kevin even mentioned before was really notable about American Express. I think that the hurdle rates to clear right now, we got to be at expectations and ideally above them. Of course, whenever, there is potential concern about a recession, we can see, of course, consumers are going to be spending on a credit card. And so those can buff up earnings at times. And so I have no issue with the financials. Again, I just would stick more with your bigger names like a JP Morgan, like a Wells Fargo, or a Citi.
All right, we'll leave it there. Ted Thatcher, President, Bright Lake Wealth Management. Thank you so much for your insight, Ted.